Alrighty, folks, you have now reached the end of the course. This is the last module of this course, and we're going to jump into the final parts, just the nitty-gritty, getting all the loose ends tied up. But right before we jump into that, I want to just go through the scenarios that we looked at from yesterday's plans that we had gone through together. So we looked at two specific setups with Tesla and NVIDIA for the day trades, and you can see that NVIDIA actually fell right after that. Obviously, I didn't trade this because I was just busy with the course launch. But we broke below that 191 level, and then we came straight down into the 190. We broke through the 192 level, and then we came straight down into this 190, 191 level, and it continues to be bearish here. So remember that if you're looking for that confirmation to play that downside, then you're going to be looking on the two-wave setup for this now to make a wave up, right? A wave up, and then a rejection, and then that could possibly be our entry, okay? And once we take that entry, then we can ride this wave to the downside for the swing trade. Remember, this is a longer term trade, right? If you were just playing the day trade, which is what we were planning yesterday, then that trade already played out. That would have profited a little bit. And so that's how you kind of go about with your plans and setups, how you observe the risk to reward ratios, how you choose the contracts, and more importantly, your stop losses and things like that. Now, I also wanted to mention another thing was we had gone through the setup for the stop loss in terms of, what kind of a way you can use to set up the stop loss, which was either a delta positioning or you can use an arbitrary value. But remember that when we were talking about stop losses in the previous module, in the technical analysis portion, we spoke about different types of stop losses. And so the most common one that I told you guys you should use is the stop limit order, right? And so yesterday, when we were going through those examples, I wanted to make sure that I close the loop here and also include how you set the stop limit so that you are not confused on what happens there. So for example, if we were thinking about the NVIDIA contract, and let's say it was $3.60, right? And then we determined that the delta was 0.3 or something like that. Just to make it really easy, it was 0.3, and then we had a times 2 move for the delta because we were not expecting it to move beyond this, so we were expecting that $2 risk, right? Which gave us a 0.6 of total, right? That means that minus your 60 cents here, right? This would bring your stop loss to $3, right? Remember, that was the delta calculation, right? We were looking at the delta possibility, and we couldn't do Tesla. Why? Because Tesla had too high of an implied volatility, and that was throwing off the calculation of the stop loss based on delta. So in this case, when you have $3.60 as, let's say, the contract price, right? Contract price. Then here you have the stop loss, right? Which is 60 cents based on the 2 delta move, and we wanted to take on $2 of risk to get $4 of reward. You remember that in the previous video? Well, that leaves us with a stop loss of $3. So then how do you set your stop limit order, right? How do you set your stop limit order? And if you remember in the previous video, the spread, right? The spread between the bid and the ask was roughly about 5 cents, right? And sometimes if the spread gets wider and volatility is low, then the spread can get bigger. But in this case, everybody was trading NVIDIA and Tesla yesterday, so the spread was very tight, right? So in this case, when you set a stop limit order, you're going to get 2 fields to input. The first field is going to be called a stop price. Then the second thing is going to be called a limit price. Okay? So what becomes the limit price? The limit price is the absolute bottom, right? The lowest price you want to get. That becomes $3. Okay? The stop price is the price above it. Remember, it has to trigger the stop price first, then it converts it into a limit order. So that should be 305 because the spread is 5 cents. Okay? I wanted to just close this loop so that you don't go confused and you don't misunderstand things. So when you're setting the stop limit order, your stop price will become 305 and the limit price will become $3, and that would be the stop loss. And then you let your trade ride, and obviously from there on you take profits or you move your stop loss to the break even once you're in profits, and so on and so forth, as we had talked about in scaling in and scaling out module, right? Now, obviously there's a lot more complexities to this. There are nuances, there are different things, and all of this you will greatly benefit if you attend the live trading sessions, because in the live trading sessions, I guide you step by step. Okay, guys, I'm going to do this. I'm doing this now. I'm going to move my stop to this level. I'm going to add some contracts here. I'm going to move my stop to this level and secure this profits. I'm taking this many contracts off. I'm taking this amount of risk allocation. The step-by-step process is all introduced to you when you signed up for the Discord. Now, if you're one of the individuals who signed up for just the course portion and you want to add the Discord access on, you can always reach out to us and we'll help you to fix that, okay? But if you're somebody who bought the Discord access together with the course, then you're not going to have this issue, because you will be trading live with us every single day when there is a trading day, right? Not to mention you have the pre-market live streams, the newsletters, and all of those things to supplement your learning. The Discord has a ton of resources for you to learn from, and that's exactly what it is. It's a 1-year internship and / mentorship with me, so that you can really, really fast track your learning and get everything in a very efficient manner, so that you don't fall through the cracks and you don't keep stumbling and then trying again and stumbling and trying again. It's more streamlined, and that practical application of everything that you're learning in this course really shines through. We've seen great results from students who put in 1 year of efforts into a long-term process. If you are just thinking that I'm going to just put in efforts for 6 months and I want to make some quick money, you're not going to succeed. I'm going to tell you that right now. It's going to be very tough. You will find that you might go 2 steps forward and then 3 steps back, and it's just detrimental to your learning process. So I've created this entire course in such a way that you have a very, very handheld approach throughout the entire process. Okay, great. Let's jump into the last part of this course. So, common mistakes. The first most common mistake that traders make are going for a delta versus gamma focus or a gamma versus delta focus. Okay, and let's talk about what these two things are. Now, for yesterday, for example, the trades at Nvidia, you had 2 options here. The first option would be that you go for a delta focused scalp / day trade, right? A short-term trade that its aim is to stack delta instead of exposure to gamma. What does that mean? When we talk about delta stacking, we're talking about the fact that you buy a in-the-money option, okay? Because why? In-the-money options have a higher delta, right? Versus, what is the converse choice? It's to buy a gamma-driven contract, which means what? It is out the money, right? That means you buy something like the 187.50 strike versus the 195 strike, right? Delta focused, gamma focused. Why is this gamma focused, the 187.50 strike? I'm giving you an example, right? Because here there is a bigger acceleration for gamma before you reach the strike, which is at the money, right? But with the delta focus, you are already past this part of the curve on delta, right? Remember, delta goes like this and then gamma goes like this, right? On the chart, which I showed you the relationship between delta and gamma. So with the gamma focus, you have a lot of acceleration of gamma. With the delta focus, you are already here on the delta curve. So you are efficiently adding to delta, but you're not adding to gamma. In a short term, what is that going to mean? It's going to mean that the contract price is going to be increased. Okay? The gamma focus is usually going to have a lower contract price, right? So why do people always make mistakes here? Because if you're expecting a big move and the market is very volatile, you should always choose the gamma focus contract. But if you're expecting like the market to be sluggish and you're just playing a low volatility market where things are just kind of moving, like this example where I was showing you yesterday with Nvidia and Tesla, where the market wasn't really like dropping very quickly, but it was more like just kind of sluggishly falling, that's when you should take advantage of a delta focused option. Okay, that means you go closer to the money. Now, yesterday I gave you the balanced approach, which was just taking 1 strike out of the money, right? And that's not a bad choice at all. Remember, there is no right or wrong choice. I'm just giving you all the options that you have and the benefits of certain things versus other things. Because with the delta focus option, your percentage gain will be lower. With the gamma focus option, your percentage gain will be much higher. Only if you hit the strike, right? Because if you don't hit the strike, then what happens? Then the contract never gets to peak gamma, Remember, gamma peaks at the money. So it will only get to at the money if it reaches your strike, right? So this is some of the mistakes that people do. They often go for a gamma trade when the conditions are not in the right manner, and they often go for a delta trade when the conditions are not in the right manner. You have to know when to choose the right contract. So if the market is volatile and you see prices are falling very quickly and momentum is high, go for the gamma focus trade. That's going to pay you more, and a lot of people are going to rush those contracts, and the IV is going to go up higher. And what happens when IV goes up higher? Gamma spikes as well, right? And when gamma spikes, what does that mean? Delta is also spiking at a quicker rate, right? So that's going to deliver you higher percentage gains when you go for that scenario. But in a lower, less volatile market, right, you'll have to risk a little bit more and pay higher prices for the delta focus trade. So the analogy here is like the tortoise and the hare, right? The tortoise is going to be like slow and steady, wins the race. The hare is going to be helter-skelter and run, but then wins the race quicker, but then, like kind of has that momentum behind it, right? So you want to have different options for different market conditions. That is the highlight of what I'm trying to explain with this problem that traders focus on. The problem is traders often just try to keep to one thing. They say it's easier for me to just, I just want to trade one way. But that in reality doesn't really work, okay? Because the market is not a one-size-fit-all glove. Every single day is different. Every single day has a different kind of a series of events that happen. For example, because this week is a huge week of earnings, there's FOMC rate decision that's going to be out, and then economic news that's going to be posted on Friday. The market's taking a more sluggish approach on Monday and Tuesday, right? It's likely to take a more sluggish approach on Monday and Tuesday. Until FOMC news comes out and then everything gets posted, then the market's likely to become more volatile. So the first 1 to 2 days of the market, you try to find delta focus plays where you can benefit from the sluggish movement. And then when the market becomes volatile, you can start to take more out the money contracts, but not too out the money, okay? I will explain about why this is a problem too next time, just in a couple minutes from now, right? So the next problem, unavailability of strikes. This is a really, really terrible one also. So I like to give the example of Apple here, okay? And this is a very common problem that traders face that you need to be really aware of. So I'm going to pull into the 15-minute chart here, and we're going to observe, this price action here. Okay, so let's say you have Apple in a big uptrend here, right? And now you're, starting to see, or you're starting to verify if Apple is indeed switching trends, and it's moving into a downtrend, right? Let's see. So you'll be looking for the two-wave confirmation on the 15-minute, and similar to NVIDIA, you would have to make choices for options, right? One of the biggest mistakes that people do is when there is not the available strike for the target price that they want, they go more out the money for the day trade or the scalp, okay? So let me give you the example. Let us say, hypothetically speaking, you establish that the next demand zone for Apple is at around 140, okay, right? So you think that Apple's going to come down here into this demand zone to retest it because it is reversing its trend. And the impulsive wave is likely to get there if it can break this key pivot point at 143, which is what is at currently, right? This is a pivot point because it was a previous resistance and now it is a support, right? And then you go into the options chain and you want to day trade this. So this is the hypothetical scenario. And when you go into the options chain, the only strike you see is not 140 or 141 or 142, but instead is 138 or 137. Okay? So the strike that you want for the target that you want is not available. Okay? The other problem is people often try to go for the lowest point here and they say, oh, this is the strike I'm going to take, like 139. That's also wrong, because nothing is guaranteed in the stock market. You have to remember this. I keep saying it over and over again, right? Nothing is guaranteed. So there's no guarantee that you will go all the way down here to touch this. And if you take such an out the money contract and the contract doesn't get there and it has a short expiry, what's going to happen? The contract is going to lose value instead of gaining value, because the extrinsic value of the contract is dropping off. And what is left is only the intrinsic value, which is the actual moneyness of the contract, the ability to exercise it. If you're trading this option on a Thursday and a Friday, you'll realize, what the heck, the stock price is moving down, but I'm not in profits. Why? This is one of the mistakes that traders make. The reason why this happens is because you've chosen the wrong strike. And market dealers have forced you to take the strike that is unlikely to hit. So you have to choose realistic strikes. Okay? Realistic strikes. This is a very, very important part, right? So instead of going for the 140 or 139, your aim should be to go for the 141. One strike out the money. That's the reason why we go one strike out of the money. And that is why I have put that as the bread and butter guideline for scalp trades and day trades. Because if you choose too far of an expiry, too far of a strike price, what's going to happen? The gamma's not going to accelerate and the delta is not even going to accelerate. And this is a big mistake that people make. The unavailability of strikes forces people to take further out strikes that doesn't pay them. And then they get frustrated and then they're annoyed at themselves for not being in profits and the contract's not moving as to their expectations. They close out and then suddenly, the stock will move. So this is an important thing that you need to take note of. When there is no availability of strikes for the strike that you want, and let's say in this case it is supposed to be 139 or 140, right? Don't go further out the money, go further in the money. That additional delta will benefit you by paying for the additional risk that you're taking on, okay? And as long as it's one strike away, you have a decent amount of delta to build up, which means that you will have a decent amount of gamma to build up, okay? So we're getting into the fine-tuning of choosing contracts now, right? So I hope that was somewhat clear and you understand that part. Now, next, out the money options, lottos. Let's talk about them. Sure, guys, it's really fun to degen and take trades that you think might not happen, but what if it does? But remember not to get carried away with this, okay? You can ask anybody on the Discord community how often I take these degen lottos. They're only in extenuating circumstances when volatility is extremely crazy. That's the only way I will take those contracts. The problem with majority of traders that are new is they always start fantasizing about all the possible things that can happen, the gains that they can make. They start concentrating on all of the percentage profits. Oh, I'm going to win 1,000% if this happens. I could win 500% if this happens. If you ever hear somebody say, "Oh man, this could be a multi-bagger," or "Man, this is gonna give me the bag," immediately disassociate yourself from that person, because this is not healthy trading habits. If you wanted those kinds of odds, go to the casino. You have better odds there. Okay? This is not a game for like you're playing in a casino. This is where you are choosing probabilistic outcomes that have the better chances of making it to the strike price that you have planned. Okay? One of the most common problems that arise from this is somebody takes a lottery contract, something that is very far out the money, and then the stock price moves in that direction and it hits. Now they're hooked. It's like a drug. They've taken the contract and they've gotten a taste of what could be. But is it a realistic taste? It's not. So what happens is they keep chasing that dopamine in their brain. It's like, man, I want to hit those numbers again, I'm not satisfied with 20% consistently or 30% consistently anymore, which should be what you're aiming for, right? Every day, if day in, day out, you can increase your portfolio value by 20%. Do you know what is the compounding return per year? It's an insane astronomical amount, which, by the way, is unrealistic, right? If you can make like 5% a day on your portfolio, that's a huge win already, right? I don't even think I hit those numbers, right? You have to be consistent. So 20%, 30% should be like your bread and butter. You see 20%, you take it off the table, stack that amount. Next, and then that's it, you're done for the day. You maximum take 2 trades, 3 trades per day, you're done. You walk away, do something else, focus on life. Go read a book, go buy more things, courses, learn from people, buy books, listen to podcasts, right? All those things. Focus on other things to your learning experience. Rather than sitting there and figuring out where's the next 100%, 1000%, 500% lottery I'm going to take to win. And then get another dopamine hit. And then you're a slave to that process, right? Lotteries or degen contracts that you take should make up 1% of your trading style. Like only when there's an extenuating circumstance in the market, volatility is super high, contracts like prices are moving by 10% or something like that. Okay, we can go for those kinds of contracts, right? If the market's moving crazy. But not in a situation like every day or every week where every week you're like, you know what, I'm going to degen away a couple $100 on contracts. That's how you blow up your account. Because you try it one time, it hits. Next time you try it, it loses. You're back to square one with zero in your account. Then you're chasing that dopamine hit again. Oh man, I need to make it big. I want to hit it big, right? I think you see where I'm going with this. So stop doing that. That's what's really causing you to cross over the profitability. Remain disciplined. That's what's going to get you there. If you're really trying to build this into a sustainable, scalable, repeatable system, then you have to be disciplined. There's nothing in life that comes without discipline, right? You want six-pack abs, you have to go to the gym and be disciplined, right? You want healthy skin, you have to be disciplined. You want, to be good at your job and get promoted, you have to be disciplined. You have to show up to work, don't you? You have to put in the hours. You have to put in the work. You have to perform up to your boss's standards, right? That's obviously I'm giving you a light example, but you get what I'm saying, right? Everything is about discipline. So stay disciplined. Lastly, stop loss misjudgments. Another one. A lot of people tend to make misjudgments about their stop loss. Okay, and the most common thing, I don't know, after 3 years of mentoring people and taking feedback from students, over thousands of students that we have had, the most common feedback that I receive is this: hey T, I'm not sure why, but I keep getting stopped out, and then after that the stock moves against me and goes to that initial planned move. I can't figure it out why this is happening to me. I keep getting stopped out, and then it moves in that direction anyway. Why is this happening? This is what we call stop loss misjudgment, and it stems from a deeper problem. It comes from your entry. The entry into the position is wrong, therefore your setup of the stop loss is wrong. That's what's getting you stopped out. Okay, sometimes it could also be your stop loss positioning, where you're actually setting your stop loss, but majority of the time, I've seen 75% of the time, the problem is the entry, not the stop loss. So let's look at an example here. Okay, let's say you're waiting for this Apple trade to form here. You have established that it's making a down impulsive wave for a possible trend reversal. Still not confirmed because this is still in an uptrend, right? It's not broken down and then retrace back up to reject and then move back down, which will give you that confirmation yet. Right now, you're still in an uptrend that is still trying to break into a downtrend, right? Which is where the market's at right now. So the most common problem that I see is people try to enter their short positions here, when it's already far down, right? It's already far down. So what has happened here? You have overpaid for the contract, okay? Versus when, let's say you entered the short position when it pulled back, right? Or you waited for the pullback, right? Let's say you didn't enter here and you wait for the pullback. Then you see the rejection. And how do you see the rejection? You, once again, reminding you, you see those candlestick reversal patterns, right? Look for those. They will appear, right? Maybe a doji, right? Maybe a doji with a bearish engulfing candle, right? Maybe a pin bar, right? For example. Maybe tweezers, right? That's another example. And then you see rejection. If you buy the contract on the pullback, your stop loss will be properly assigned. The reason why you're getting stopped out is because you buy the contract at the highest possible price when everybody's buying it. So what happens here? You're paying the most price. Let me give you an example. Let's say you buy the contract here and it's $5. Okay, this is person number 1. Person number 2 waited for the pullback. Obviously, the contract is going to be cheaper for the put option. So let's say the contract here is $3.50. This person sets a stop loss of, let's say, 30%. Right? What is 30% of $5? It's going to be $1.50. Right? So what's your stop loss going to be? Minus 150 is $3.50. What do you know? On the pullback, person number 2 just entered the position, but person number 1 got stopped out. Do you see what's the problem here? Then the move happens. This person is still in the trade because let's just assume he didn't put like exact perfect 30%. Maybe he put like, 35, whatever, right? But I think you understand what I'm getting at here. This person, right? Sorry, person number 1, right? This person who paid $5 for the contract, right? Got stopped out at $3.50 because his stop loss is 30%, right? But then person number 2 is just entering the contract. His stop loss is now 30% from $3.50, which is roughly about 90 cents, or maybe $1, right? 30%. So that's 30% of this is going to be, let's just say it's $1, right? So $3.50 minus the $1 is $2.50. His stop loss is above, right? It's above him. So he won't get stopped out, not until the trend reverses. That is the essence. Because what has happened here? Because you have entered at the wrong position, this person gets stopped out, and then the move happens anyway, and that's why you guys keep complaining about, man, I don't know why I get stopped out, and then, the trade moves in the direction anyway. It's your entry that's the problem. Your entry, you didn't wait for the pullback. Here, you just aren't patient enough. That's the problem. So patience is the lesson here. Discipline, patience. Two of the most important things in the stock market. Because why? 90% of the damn time, you're going to be sitting around waiting for something to happen in the stock market. And you have to be patient, right? Did I take a short trade on Apple or Nvidia today? No, I didn't. Granted, okay, I was busy, but I saw the opportunity. I just didn't. Why? Because anything can happen. The market can reverse. You can go back up. And we will have a wave up, right? But a lot of you get panicked. The moment you see prices move down, you're like, oh no, I need to enter now. I'm going to lose out on this opportunity. Dude, or dudette, we are in a huge price up wave. Look at the bigger time frame. What goes up must come down temporarily. So be patient, right? So this is the reason why. So stop loss misjudgments are one of the biggest problems, but they stem from your entry. Okay? So patience is the lesson here, and I hope that you understand what I'm talking about. And these are just some of the common problems that I see, faced by traders. And that's all I have for you guys. Now, I'm going to be adding subsequent modules to this course. So what's going to happen in the future is you'll see more modules appear in the below this, and there will be new. And when I send out a new module, I will let you guys know in the Telegram group. I will say, hey, there's a new module, go watch it. So make sure that you sign up or you are access the student Telegram group, okay? Or you're a part of the Discord, then you will also get, of course, access to that, okay? I'm also intending to create a new channel in the Discord exclusively for people who are part of this course, so that you also have, just that cross-platform. And I'll post whatever that I post in this Telegram group, I'll try to post in the Discord as well, or the other way around. So you've come to the end. And I want to take this couple last minutes to thank you guys. First of all, thank you for taking this course. I hope that it has been helpful for you. I hope that every single thing that you wanted or you expected has been answered. If it hasn't been, put a comment in the group chat and I'll address it. I'll include a video for it. Okay? I'm here for your growth. You need to absolutely know that. I want to make sure that all of us have a one-on-one interaction at some point. And so sometime in the future, if you require a one-on-one session with me, reach out to me. We can always jump onto a Zoom call and get that sorted, okay? So this entire course, I hope that it has given you insights that, are going to help you on your growth. But remember that this is just one step of the way. Now the real work begins. Okay? The real work begins with you applying everything, learning through the live trading sessions on Discord, listening to what we're going through as market conditions, and then adapting to the market conditions. That's the benefit of being a part of the community, because you're constantly being updated on what's going on, especially if you're picking up day trading, right? So thank you very much for attending this course. If you found this course useful, I would really appreciate it. If you maybe wrote us a testimonial on the Discord page, that would be really, really helpful. Take some time, maybe 2 minutes. Most importantly, I want the testimonial to come from your heart. Please don't just think like I'm asking you to write a testimonial for us to promote this course more. Even though yes, we do promote the course, we're not so aggressive in marketing, because I believe that a good product sells itself, right? So if you can find 2 minutes to write a heartfelt gratitude about the course, then I would love it. If you think that we could improve on something, include that in the testimonial. It shouldn't be one-sided, right? I love to hear feedback, constructive criticism, because we always want to improve. We always want to make it better for you guys. And I'm gonna add more modules in the future, so keep a loop on. I'll keep you in the loop when those things happen. And yeah, I wish you all the best on your trading journey, and we will see you next time.